Hello, everyone, and welcome to the Catalyst Funding September Real Estate Market Update. Thank you, everyone, for joining our webinar. And I just want to first of all say that we have a special guest today, and I'm going to let Wade do the introduction for our special guest. But before we do that, I just want to let everyone know, typically we have this disclaimer, and that is that this presentation is definitely for your benefit, and all the information, the documents, the estimations presented here, they are something that we want to benefit you greatly, but we also want you to know in the disclaimer that any decisions you make after this, any loss or damage that you may incur, we are not liable for that, but we do hope this presentation benefits you. So with that being said, thank you for attending the September market update. And Wade, I'll let you introduce our special guest.
Yeah, and I'll certainly let Steve talk a little bit about his background, but we partner with Steve on quite a few different things. We attend a lot of the same industry events, and we've always had a great opinion of Steve. He's helped a tremendous amount of investors out there locate excellent deals. That's one of the most important things whenever you're a real estate investor, is having the technology to find high quality opportunities, and that's where Steve and his team make a big impact, along with having quite a few meetups across the country where they really help bring a lot of the better investors in different markets together to share ideas, network, and to create differences in each other's lives. So Steve, very happy to have you here today. Do you want to tell us a little bit more about what you and your team do for investors out there?
Thank you, Wade. Thank you for the introduction, and really glad to be here. Honored to be here as always. With Real Estate IQ, our goal is to help you win in real estate. So if you are looking for deals, and actually we just launched, this is an exciting time for us. We just launched a membership, new membership for Real Estate IQ, and we're betaing the product right now. And it's meant to either, if you're an investor, you're trying to acquire a portfolio, we'll help you with that. And if you're also a entrepreneur in the real estate business, we also have a lot of resources that can help you grow. You know, as you guys know, it takes a lot to grow a business, and we need a lot of help. So we want to share a lot of that experience and also resources to help you grow. Back to you. Wait.
So Steve, so when you say help them acquire a portfolio, are you talking about like as individual deals, or you mean like going in and buying a bulk of properties at one time?
I think we're open to those because we have the data, and it depends on really, you know, what the investors' need is. So I think we within our community, there are more folks that are looking into buying individual houses and kind of buy it one at a time.
Yeah.
But you know, buying a portfolio, we also have the competence for that.
Nice.
We're gonna do it together.
That's right.
Perfect.
All right.
So as you know, at Catalyst Funding, our founder and CEO, and as well as our director of lending, we have Wade and Jeff with us today with a ton of expertise and experience to speak on where we are in the market in September of 2022. So without any further ado, we'll jump into our Catalyst value propositions.
Sure. And for those of you that do not know, our passion is to be your one-stop shop for all your real estate investment needs from a lending perspective. We provide hard money, which is the money to purchase and repair distressed real estate, as well as the widest variety of permanent financing options out there, including conventional loans, non-conventional loans, non-qualified mortgages, DSCR type loans, which are incredibly popular right now. We also can help you with your small multifamily needs. We on both the hard money and the permanent financing, and we're really lending everywhere in the state of Texas on our hard money, including as well as Georgia. And then on our permanent financing, we can lend anywhere in the country. So if you're looking for those non-QM loans, you're looking for those conforming loans, we can do those products anywhere in the country. We are built by real estate investors as well. We own our own pretty large single family portfolio. So we try to take that experience and help you avoid some of the challenges that we've faced and take advantage of some of the lessons we've learned over the years. Been involved in thousands of transactions. And one of our secret sauces is that you have a single point of contact for all your loans. So that's whether if you want to refinance your primary home to get cash out to fuel your real estate investment goals, or if you're going to get a hard money for a single family, or hard money for a 20-unit apartment complex, or permanent financing, all with one credit pull, one single point of contact loan option. It just makes your communication a lot easier, or if you're a busy professional who has a lot of other things going on, or if you're a full-time investor. We average 5-star customer service reviews on all social media platforms like Google and Facebook, and through many of the big mentorship organizations out there that we sponsor as well. We have special programs for high qualified investors that offer excellent pricing and higher LTVs. And we actually had 9 QM loans with FICO scores as low as 620. That's much lower than the industry standard. So even if you only have a 620 FICO, you can still get into the game and start building wealth through real estate investing. That's an excellent opportunity. And then definitely get with us on our short-term rental loans. We have some products, if you're in that space for Airbnb, VRBO type properties, and oftentimes it's tough to get that debt service coverage ratio that you need to get qualified for these DSCR loans. We have a product that allows you to go up to a very strong LTV with no DSCR and no personal income requirement. Very unique product that can help you get into that very exciting space. And with that being said, Derek, I think we're ready to dive into the presentation. Jeff, if you want to start us off.
Sure. So I'll just kind of read through this page, and then Steve, Wade, feel free to offer your opinion. But this is an article from Bankrate. It says housing demand in our current cycle has been driven largely by demographics. Oh, we lost Steve. There he is. Okay, sorry.
I'm here.
All right. And I was reading this paragraph. So as of mid-September, the benchmark 30-year rate mortgage average is hovering just north of 6%, and skyrocketing home prices are finally starting to drop, albeit slowly. I just looked at there was just an article in Wall Street Journal today that said the national rate hit 6.7, which is the highest it's been since the financial crisis. And just to give you an idea of how quickly things have accelerated on the rate front, a year ago, that number was 3%. So it has gone from 3, it's more than doubled in a year's time. So rates are really starting to impact everything involved. So housing demand in our current cycle has been driven largely by demographics. We have the largest cohort in U.S. history of young adults between 25 and 34, prime age for household formation and home buying, and this group will continue to propel demand for the next 2 or 3 years. If a major lowering of prices does come to pass, it could allow many millennial home buyers who've been priced out of the market to finally get a chance at home ownership. So we've been talking about like this cohort for a while now on these webinars about how there's just this massive group of people that are at the home buying age ready to go, but for one reason or another they couldn't do it, whether it's prices, now rates. So if they start getting a little bit of relief, that might fill in that demand, or just keep it consistent more so than anything else. So that if there is some reduction in prices, it will probably be pretty gradual or minor. I don't know, Steve, if you have any thoughts on it or what you guys are seeing.
Yeah, we are. So maybe if I can kind of split it into, like, there are a group of markets they're already seeing a pretty big price drop. I think like California and New York, they're seeing some of the big cities that are hitting some high single-digit drops in their pricing. But in Texas, I think we are somewhat protected just because there's a lot of demand in our housing still. I read that Austin might be on that top 10 list on the drops, but I haven't looked into that too much. They are not the top 5. Another thing I wanted to share is there's a sentiment of folks saying that, hey, who cares if the interest rate is high now? I can buy the house, and when the rate comes down, we'll refinance it. But I don't know how prominent that thinking is for a consumer home buyer.
I think for the consumer home buyers, that does not seem to be taking hold as much at the moment. It may settle in over time. Where we are seeing that really happen is with the investors. So what investors are seeing is they're getting lower priced opportunities than they would have before rates went up. And the exciting thing about that is you can never change the price you paid, right? The price you paid is the price you paid. So that's the deal you got. What you can do is change your rate. So if you can get in now, while deals are better than they were in the past, there's not as much competition. Some people have backed away a little bit from investing, but in my opinion, the more savvy investors are very aggressive right now. And you get that deeper discounted deal whenever rates inevitably go down. Just if you can cash flow now at 6.7, 7.5%, wherever you end up, depending on the product you're in, man, what cash flow will you have when rates inevitably come back down? Because I think what most prognosticators are saying, we tend to agree with it. Steve, I'm interested to hear what you think, is that, rates cannot go up this high forever. Eventually, there's going to be a soft or a hard landing recession. There's already a technical recession now, but how severe it gets, then they're going to have to lower rates again. And that's going to present these people who are cash flowing $300-400 a month now. Just imagine what they'll be if rates get back down to 3, 4, 5%, right? Really strong cash flowing assets that they can get at discounted prices.
Yeah, I would agree. I think the key here is having staying power. If you're cash flowing from the property, you're good. Who cares? I think the opportunity is happening now. We're actually seeing a lot more investors joining back in the game during the pandemic, where we see a skyrocketing in prices. There's not as much deals for investors, but now we're seeing more clients, coming back and joining, and they're signing up. They're actually they're taking advantage of like the annual plans, so they can get a little bit lower price. And seems to me what that signals is that they are looking at it from like, hey, I'm ready to like look at this for the next year because I see a lot of opportunities coming up. We're also seeing a last comment here. We're also seeing an uptick in foreclosures also. In my humble opinion,
Is that localized or national?
It is. We're in about 4 states. We're seeing that in all 4 states. And I was reading some national reports that in general that's also trending up, but that's not firsthand data that we have. Another comment I wanted to make is that when the prices were climbing up, I think what happened is these motivated motivated sellers, they are looking at multiple offers. Like everybody is giving them an offer, and they had more leverage. And as the housing starts to cool down, I think there's probably going to be easier to negotiate a deal and win over the deal from these motivated sellers. There's probably a little more desperation as well.
Yeah, if you look at we'll get down to the city. Like I just looking at Houston, for example. If you look at, I always look at sales versus listings, just that simple number, like how many houses are for sale, how many sold. And if you look at this year versus last year, those numbers are significantly different. There were fewer houses for sale and a lot more sales as opposed to now, where there are a lot more houses for sale and fewer sales. So it is getting a little easier for your buyers and your investors. And so, maybe those deals where they're dropping 30, 40 grand out of pocket, maybe that comes down a little bit, and then get into deals a little cheaper now.
Yeah.
Absolutely. Let's look at that next slide. So many buyers, and these are retail buyers, right? These are not investors. On a side note, we're very fortunate, we feel. We broke a record last month. We're very close to breaking a record this month in our money origination. So investors are being very aggressive at the moment. I hear the same thing from other people that I know that own investment lending companies, but definitely in the retail space, that business is very slow. Mortgage applications at a 22-year low. So there are fewer people who are aggressively moving into the market right now. And there's, the EVP at Clear Capital says that, there's definitely some home price appreciation slowdown there. The year-over-year appreciation fell to 16.7% from 20% in July. So this is in large part deceleration with regionalized home price depreciation, as Steve said earlier. Really, the home price depreciation is not everywhere by any means, and it's really impacting where the migration is coming from and where it's going to, right? The most stable places are where these migrations are taking place from New York, California, and other places like that into the Texas, Florida's, Tennessee's. And this has been an ongoing trend throughout the majority of the COVID timeframe, right? So I think that's very regionalized. But the other thing that we're going to see is how long are people that really want to get into a home going to hold off, right? How can they hold off for years? Or are they just hoping on a quick change? I do think they're going to start to move back in whenever the recency bias starts to fade away, because even the rates right now are not high historically. They're actually very reasonable historically. They're just very high compared to where we were a year ago. And I think once that recency bias starts to wane, we'll start to see more of these retail buyers move back into the space as well. Anything else on that, or no?
Okay, so forecast prices nationally. So this is from July to August. So CoreLogic HPI forecast indicates home prices will increase on a month-over-month basis by just 0.3 from July to August, and on a year-over-year basis by 3.8 from July 2022 to July 2023. So like you said, it's not necessarily a decline, it's more of a deceleration when it comes to year-over-year, especially. I mean, I think month to month you have a little more seasonality here and there, but I look at year-over-year, and while it's not 10, 15 what it was last year, it's still positive, right?
I'm continually bullish about the Texas market. Oh, we're going here now, so let's go.
Yeah, why don't you?
Hey, real quick,
You want
Steve,
to talk a little bit about what you think about Texas, there, Steve?
I was going to ask you what the states are that you guys work in too. You said you guys operate in 4 states?
Yeah, right now we're in Texas, Florida, Georgia, and Utah. We're looking at 2 additional states. We got a couple of requests, and so we're doing some preliminary research on those. So we're kind of in the growing stage. We wanna cover more states. So anybody who are out or interested in out of state type of motivate seller leads, let us know. Let's do it together.
Great.
And then I guess my take with Texas is from a population and job growth standpoint. I think we're still experiencing a high growth in the entire state. Where I think we're the #1 state in the entire nation, and I think there's still a big housing shortage. I was reading that the housing demands might be shifting to multifamily because rent is now more affordable than buying a house. So that might be a little bit of the side threat for home purchasing is on the multifamily side. But I still think that in general, inventory is low, housing inventory is low, and there's always going to be demand. So I'm quite bullish about appreciation in Texas.
A couple of stats to add to that, which aren't in the presentation, but I did see that Texas ranks first among the 50 states in the District of Columbia for percentage gain in non-farm payroll employment over the past 12 months. So it's a very strong statistic. Actually, the Texas state economy has grown 1% year over year, whereas the rest of the country collectively is in a technical recession, right? Two straight quarters of GDP reduction. And then yeah, just overall, there's a lot of positivity in the Texas employment market, despite the fact that a lot of people are moving here. So unemployment numbers are still very strong relative to the rest of the country, despite a lot of people moving here. So that's a very strong indication of a robust job market. Jeff, do you have any thoughts on this? Do you want to move on to the next slide?
Oh, so we didn't really hit those numbers. If you want to go back real quick, we didn't hit those numbers on that slide, right?
Yep.
This is kind of quantifies appreciation and why investing is so important, because over the long haul, I mean, these numbers get really, really big, really fast. So just as far as Texas is concerned, 1 quarter appreciation is a 5% increase. Over 4 quarters or a year, it's been a 20% increase. Over the last 5 years, 64%, 10-year, almost 100%, and then 1991, over 300%. So, I mean, that's kind of the point, right? People that try and time the market or wait and see, if anybody here can with 100% confidence time the market, then that's just not the truth, right? Nobody has the ability to know exactly when the market's going to go up or down. You can have ideas and guesses, but for the most part, no matter what, if you're buying properties at a pretty consistent clip over time, you're going to be winning. You're going to be winning eventually down the road. Whether the market go down a little bit, okay, fine. You hold on to that property over enough time, that house is going to be a winner. And you just keep doing that over and over again, you'll be a big winner, right? Next slide. So I'll read through this one. So Texas housing supply. So while home building is expected to continue decelerating, the state's current supply is starting to accumulate. Active listings rose more than 17,000 units since May. This loosening up of housing availability indicates a breakthrough after the abnormally low inventories of the past 2 years. As a result, Texas's housing supply, which has been below 2 months, recovered to 2.2 months of inventory. 6 to 6.5 is considered balanced. San Antonio was at the highest at 2.5, and Dallas was the lowest at 1.9. So I was very surprised to read that Dallas was the lowest and not our friends in Austin. I thought for sure that would be the lowest, but we'll get to that slide later, it's actually slowed down quite a bit to where Dallas is actually a little bit tougher than Austin to find a property.
Next slide, please. Yeah, so, and this kind of goes in line with what Jeff has been talking about, which I think it's very important to keep context in mind, right? Whenever we say that for example, median home prices dropped by 5,000, that's month over month, not year over year, right? That's a month over month reduction. Still, year over year, the state's up 13.2%. The home prices did fall most significantly in Austin and DFW, 7,000 and 8,000 respectively. Houston and San Antonio were a little bit less. And the other thing to keep in mind is seasonality. I mean, for decades, seasonality, you would almost always see that. Really high prices in the summer, fewer homes on the market, just a quicker cycle overall in the summer because that's when so many people want to buy. And we become a little bit jaded because I think it's just been an incredibly hot market because such a short supply and incredibly low interest rates. And seasonality is the normal part of the equation, right? So whenever we see higher days on market, slightly lower prices at times, it's really just going back to a more normalized market rather than a market that goes up every single month without question, even if you're in, December or January. So from a real estate investor perspective, keeping that context in mind is going to be critical so that you don't overcorrect to information that may just be what is normal in almost every other year that investors have been in the game, unless you've only been in it since the beginning of COVID. Anything to add to that, Steve?
Sorry, I want to address that in a little bit way, but I was staring at the picture. Is that the picture of Barton Springs?
I think it is.
Derek, you know where you got that?
You like it?
Oh, it's wonderful. I actually just came back from Austin. I flew back yesterday, and we didn't hit the Barton Spring, but that has always been on my mind. Every time we used to go to Austin, the best swim if you're a swimmer. It's like fresh water. By the way, if you're in Austin or you travel Austin, you gotta go. It's a must visit, I think, in my humble opinion. I saw a big growth in Austin downtown. We were staying by a little bit north of Rainey Street, and it used to be just dirt. And now it's all high-rise buildings, either in construction and already built out. So I think my reading was just that there's a lot of companies moving to Austin, so much growth in corporations moving there, creating jobs. Maybe a little bit on the side is that I've been talking to folks that are looking at Central Texas. And they were actually one of the first few that kind of start establishing there, and they're seeing a lot more maybe early market. They're like the early adopter, right? They went there first, and now they're quite established, and now they're seeing a lot of businesses and a lot of real estate businesses too are starting moving to Central Texas. And I I'm always quite optimistic, quite bullish about the San Antonio, south of Austin, between Austin and San Antonio, that area. So I think they're also seeing price increases as well. I don't know if that addresses here. We're still much higher.
Yeah, so Austin did pull down a little bit month over month, not year over year, obviously, but month over month, there was a little bit of a pullback, but all about the context, right? Like huge increases and then just a slight pullback, potentially somewhat based on seasonality as well, right?
Yeah, and I would probably look at a lot of cities around Austin now. Like I would be interested in kind of seeing some opportunities of that.
I did, yeah, I don't know if it was the last presentation we did or something else, but I did read where like the county that experienced the highest prices or most growth was one of those counties just north of San Antonio, in between,
Yeah.
exactly what you're talking about. The Canyon Lake area, I think, or New Braunfels in that area.
And if I would maybe make a just a comment from my personal experience, I grew up in California, and some Californians, they drive 2 hours to work. If you're working in LA, in like downtown LA, like they're willing to drive 2 hours and 2 hours back to and from work. And so when we're talking about 30-minute commutes, right? It's nothing actually. If these are the folks, migrants from California, that's nothing. Like they save an hour and a half. Well, they save 3 hours every day on commute.
3 hours, and they get about 4 times as large of a home for a comparable
Right.
price. So they're probably pretty happy campers, at least until the heat gets to them. Then maybe they'll rethink.
Correct. Lots more disposable income for them.
For sure. All right, let's check out this next slide. Talk about Houston specifically a little bit. So here we have single-family home sales fell by about 16.9% year over year. Not expecting incredibly hot market there for a very long time, and a little bit of seasonality there. We would expect the number of homes to being sold to be less. You really want to go back and look into previous years, and these numbers are very much in line and very strong numbers compared to years before the pandemic. So that's one big thing to keep in mind. But the days on market continues to tick up, 27 to 31 days. Little properties sales were down 15.8%, as you can see. In single family median home price in Houston there, according to this statistic, did increase 10.8%. That's a year over year number, right? Not a month over month number, was what we were reviewing earlier, right? So that's the key thing to keep in mind. These are year over year, comparing August of 2021 to August of 2022. Anything else to add on this slide, gentlemen?
Well, I just, like I said, I look at, I know like over the last year or so, we kept talking about acceleration and how, even though listings were way down, the sales were keeping up because everything that was getting on the market was getting gobbled up. And so now I look at those total active listings, like that's a pretty significant jump from 26,000 to 34,000, right? That's, what is that? That's 8,000. Yeah, that's quite a bit. But then, but the sales are down, right? So there's a lot more for sale and a lot less sales. So things are starting to normalize. Not that it's terrible news. I mean, 2.5 months inventory is still very low. 1.7 was just ridiculously low. The other thing was down below that, the close to original list price ratio in the little thing in orange there for single family homes has now remained below 100% for 2 months in a row, meaning fewer buyers paid above list. So like you were saying earlier, Steve, you were getting multiple offers, cash offers, and that's, people are starting to normalize, where you list a home, you're not going to get, on average, you're not going to get at or below list. You're going to get most likely below list. So it's just, like I said, not that it's terrible. It's just more normalizing of what was really, really, really hot a year ago. Steve?
My comment is more on the prices. I guess, just like Wade said, and Jeff, you did too, that the market is starting to decelerate. So we're seeing some signs of cooling. So it's not shooting all the way up. I think it's about time. It was running away from affordability And again, it's making renting more affordable than buying if it keeps going up. So I think it's a good sign. It's a good sign for home buyers, and it's a good sign for investors.
Yeah,
We got to
for sure.
stabilize the economy somehow.
So San Antonio, I'll cover San Antonio. Very similar, right? So 3,200 sales for the month. Last year, 3,700 sales, so a few, 13% less. But the prices are higher still. The average price is 390 as opposed to last year 348. So that's a 12% year-over-year increase. What we say Houston was only 9. So actually a little bit bigger jump in San Antonio, like Steve was saying. Median price jumped up 14% as well. In Houston, it was 11. So San Antonio seems to be increasing at a higher clip. Rents. So there were a lot more rents. 1,400 rental leases signed versus say 1,100 last year. That's a 28% increase. The average price is up 11%. The average rent is $1,888 versus a year. So basically from 1,900 last year is 1,700. So the rents have gone up to $200 a month. So the beautiful thing is, from a real estate investor perspective, think about it. If you bought a house 5 years ago, you didn't do anything. You didn't do anything special. You had the house. Your payments stayed the same. Maybe your property taxes go up a little bit, but just through the increase in rents, you're able to charge a couple $100 more. So you're going to go from 100 to 300 or 300 to 500 for the most part. And that's kind of what I'm talking about when I say just buy the property. Regardless if you think prices are high, just buy the property. Put a renter in there. Like Steve said, as long as you're cash flowing, who cares? That's gonna increase over time. And even if you think rates are high right now, if and when they go back down, you can just refinance if you really wanted to. But that rental increase is pretty significant in my opinion.
Yeah.
Okay, Austin. Austin, year over year, these are once again year over year statistics. So Austin is only up 5% year over year. That's definitely a more normalized appreciation level. But if you go back 2 years, then that number is astronomical because I think it was up like 36% year over year the previous year. Closed sales are definitely down significantly. Days on market up. Total sales dollar volume down, and months of inventory up to 2.9 from 2. So it's a much more reasonable ability to get into this market now, both for retail and especially for investors. But as Jeff mentioned earlier, 6 to 6.5 months is considered a stabilized market where there's equilibrium between the negotiating power of buyer and seller. And you can see we're still not anywhere close to that. And this is still in large part a seller's market, even at 2.9 months, which is a big increase over where they were. The active listings, wow, that's up significantly, but the numbers were so incredibly low before. I'm sure if you go back to look at 2019, 2018, 2017, that number of active listings is still probably incredibly low. So context, as always, is very important to keep in mind.
Just look at the numbers that they came from. Like look at the months of inventory. 2.9, that's fine, but that's up 2. So that means it was at a 0.9, this time last year. Days on market, 31 days. Okay, but that's 17 days higher than what it was before. So those numbers are just ridiculous a year ago. Unsustainable. All right, next. So Dallas. These are the Dallas stats. It's not necessarily Dallas or Fort Worth. It's kind of a hodgepodge of some of those markets up there. But the median price up 13%, very similar to what we're seeing in the other markets. The active listings up 80%. Again, not quite Austin numbers where they're up 170%. Houston's up 30% for some context. So definitely more in between Austin and Houston. Days on market, 24 days on market. Closed sales are down 6%. Months in inventory 2.3. Again, like the article said, that's the tightest in the state. I think in the previous article it was 1.9, so maybe there's a little mix match of data. or the months are different, but the point is Dallas and that area is is still very, very hot. So, and I know we talked to some investors up there in Dallas. There are some rental properties in Dallas. It's tougher than say Austin, and I know a lot of the deals as you go north, it's easier to pick up deals. Steve, you live in Dallas, right?
Yeah.
So you would be the expert there. So are the northern counties, is that where people are going for more deals?
Yeah, we're moving up more north, and kind of I'm still digesting these a big increase in active listings, guys. I was looking back at the last slide at Austin, up there 170%, and up 80%. But if you look at the months of inventory, like it's still a very low number. I think there's because when we look at the months of inventory, I think the way it's calculated is by what's on the market and what has been the trend of the sales. And I think there's probably has been quite a bit of sales as well. So as the market starts cooling, we might be seeing higher months of inventory. Again, just the signs of the market, starting to cool a little bit. That's my only comment here.
Yep.
So this is a chart we've looked at for the past several meetings. I think it's very, very insightful. And basically you have on one part of this chart, you have the US population. The other side, you have US housing starts, right? So you can see at the height of the pandemic, the height of the previous financial crisis, that's like 2006, we were building an incredible amount of homes, right? And still relative to the population, not completely out of whack with what was built in the past, but definitely a very high number. So 2200 is that number there. And then you see the US population at that time was about 300, a little bit below 310 million, right? And now it's closer to 335 million, right? But for an entire decade, we've been building exponentially fewer homes than we built in the decade moving up to the great financial crisis. So that's the competing force that we have here. Far too few homes. We've had a lot of the demographics we were talking about earlier. A lot of people were staying home. Young people are staying home longer. And now they're starting to get to an age where they want to move out. So you have the two competing forces of higher interest rates and a lot of recency bias, but just not nearly enough homes out there, especially in certain markets like Texas and other places where there's a lot of net migration. So I think this is one of the most exciting things, is that while there may be some slowdowns because of temporary shocks, because of interest rates, concerns about the economy and the stock market and different things like that, where the rubber meets the road in economics is supply and demand. And there's a tremendous amount of demand for homes. In general, people are having that skewed a little bit. Retail buyers are having that skewed by interest rates, but still there's not enough homes out there for the number of people that want them. And I think that's going to continue to keep things more steady going forward, especially as Steve said earlier, keeping geography in mind.
So I'm curious, Steve, how in tune are you to the home building? Just anecdotally, it's still, talking to guys that I know that are in the business, it still seems very difficult to get the supplies needed and to complete a house. So while things are on the upswing, it just seems like it's way more difficult, and supply chains are way more intertwined than we realized to start meeting the demand that is still there, right?
Yeah, I'm personally seeing like furnitures. It has been very slow throughout the pandemic. You can buy something, you gotta wait a couple of months to get your item. I think it's starting to get a little bit better, and maybe I'll end the comments there. I think I was reading that lumber prices has come down a little bit from its crazy price about a year ago, and so, but in terms of material supply and also housing starts, I think it's always we're still seeing, I actually was just looking at the housing start number announcements that was just released less than 10 days ago. And I think it has come, it either has gone up or it has come down, but not that much. So I think we're still seeing the housing starts hasn't been affected. But it seems to me that always the interest rate is the early indicator. So maybe it will get affected kind of the next in upcoming economic data. So interest rate is, so I wanted to ask you guys about interest rates. You know, with the interest rates now, how are you guys seeing what you can offer to investors? And does it get affected, or, you know, what are you guys kind of seeing moving forward?
Well, much of the long-term market is less out of our hands. That's really dictated by mortgage-backed securities, right? Either on the conventional and the non-conventional side, and rates are definitely up. But one thing we are seeing is a real narrowing of the gap between conventional loans and the rates we're able to offer on these non-qualified mortgages. Like, they're incredibly close. The fee structure is incredibly close. So that's a very unique situation, but it makes it very attractive for people who have either maxed out their number of Fannie Freddie homes, or self-employed, or have difficult to prove income. Definitely they are as competitive as ever in the marketplace, because they don't have to sacrifice cash flow as much if they're the DSCR type investor. But even on our hard money loans, we prime lending rates are a big impact in our borrowing costs, and across the board, it's impacting everybody. When the rates go up this much, there's a tightening of the margins quite a bit for us, and we have had to adjust some pricing for sure. And most of our competitors have as well. We've seen a few of our competitors just publish rates, which are the only rates that they have, and they're a good bit higher than where we are today. But everybody's feeling the pressure for sure. I think it's rising everywhere.
Yeah, thank you. So that's a good selling point for the self-employed, for your product.
Yeah, it is.
You're like right there with conventional lenders anyways. Really close.
And honestly, it's an easy experience, much easier than a conforming. Like with conventional loans, the rules are rigid and you have to provide a lot of information, a lot more documentation. So it is an easier road for sure on the non-QM. And in the past, we had the industry as a whole, the turn times were longer, right? And we had some of those same challenges, especially at the beginning of COVID, but we've closed a few of those transactions in like 21 business days recently, which is an incredibly fast turn time. So we're pretty excited about our ability to get that a lot more dialed in the past few months.
Yeah, let's get that in front of more folks, more borrowers.
Yep.
Fantastic.
I did want to mention one other thing too. You were mentioning the foreclosures earlier, and I actually had a friend who was kind of asking me about that. Do we see a big wave of foreclosures coming through? And I think the uptick is there. I mean, you're definitely seeing that, but that's another thing to keep in mind, in my opinion. It's contextual, right? Like they've been incredibly low for a very long time. And I was just going to throw out a couple stats that I saw recently. The average FICO score today is about a 750 versus in 2010, like during the heights of the great financial crisis, that was below 700. So a big swing in that. And another big impact then was the number of adjustable rate mortgages. There were a tremendous amount of like 2-year fixed and then 28-year adjustables, right? So whenever rates started to adjust, that made an impact. And then also just the fact that those introductory rates were very low. And even if rates didn't go up, their rate and payment were going to go up substantially. So today, only about 8% of outstanding loans are ARMs. And back during the financial crisis, 36% were ARMs, and most of them were on far shorter fixed periods. So there's two big dynamics that I do think is going to help. There may be some more discounted opportunities coming through foreclosures, but I feel pretty strongly, and a lot of other prognosticators that I've listened to or read about seem to feel like because of those two main things, it's a big difference. And that was one of the things America got right, I think, is really limiting the number of ARM loans. There's some other countries like some of the Scandinavian countries where they're like 80-85% arms right now.
Really?
Be a lot of pain there coming up. Yes, a lot of pain.
Did not know that. And go short some Scandinavian mortgage companies.
Might not be a bad idea.
Big Short Part 2. Okay, next slide. So this is something we always cover. That date is wrong. This is real. This is real. It's not 222. It is the September information. So this is basically a look at the average family income, the average cost of a mortgage, and how much of your income would be required to pay that mortgage. So if you look at numbers like Miami, LA, and New York, you know, you're in the 80% range. I'm not sure how people do that, but you know, it kind of gives you some perspective, like you said, Steve, on where people are still able to find good deals and housing is still affordable. And so that's why you're probably not going to see the crashes in certain markets that you would think in others, because it's just relative to the rest of the country, it's just very affordable. So I wrote down, because you were talking about California, I looked at 11 of the top 17 are in California. So and by top, I mean, you know, least affordable. But you can see Austin up there, top 22, Dallas 33, Houston 37. I think Houston had caught Dallas for a while there, but it seems like Dallas has gone back up. San Antonio all the way down there at 54. So, you know, still some really good opportunities. Anytime I see low numbers, I see good opportunities for investors. And, you know, certainly a lot of markets in Texas. This is every Texas market, so it maybe looks like maybe 15 or so. But a lot of Texas markets still very affordable, in the low 30% range. So I don't know if you have any of these that kind of speak to you, Steve. I don't know. I don't see any Florida on here, or sorry, the top two, Miami and Hialeah. And you said Georgia is the other state you lend in, correct?
Yeah, Georgia.
Yeah, not
Georgia,
lend, but
Atlanta.
sorry, I'm sorry, you don't lend, but you guys do.
The 39. Oh, I feel obligated to share, guys, that we just had a big a release on our pricing. We spent like the whole last year reinventing our IT infrastructure so that we can now offer city pricing, and we're just releasing that like just this past week. So for those of you who are looking into investing, you know, maybe you want to like maybe even just focus on one city, there's actually a lower price pricing now if you're only getting one city, two cities. Might be cheaper than a county, so a little more a la carte in our offering. So it might be a good time to look into Real Estate IQ, especially if you're looking into these pricing. And I would also encourage you as a client to demand for the MLS Deal Finder feature from our team. We have been reshelving that, but as time goes on, like we're looking at, you know, more estimated mortgage and how much you can do rent. I think the rental index would be a really good feature to bring back into this new portal. And our team right now, we only develop things that people are demanding for. And so I want to maybe kind of encourage everyone to get your maybe voice that feature for rental index. You can really find the deals that are affordable, and it will help cover the mortgage. This just sorry, I'm doing a little advertising for Real Estate IQ right now, but it just
Please.
the timing is just so good. I have to talk about it.
I was gonna say, like, you know, if you don't mind, I would, because maybe people don't. I mean, obviously, it's pretty clear what we do. We're a lending company, but you know, just to come to the maybe somebody who's never heard of your company, like what it is you do exactly for investors.
Sure, yeah. Guys, we have been revamping our marketing message and everything, and our goal is to help one more person win. And as the market that we're in right now, you know, we have folks that are interested in buying real estate, you know, acquiring more property. So we can help them with the lead generation and marketing data. We can actually do a lot of market analysis and find some pockets that are good for investing in. And then on the other side, we also serve entrepreneurs in the market. I think I would say that, personally, we have been blessed with a lot of help growing up as Real Estate IQ in the Texas real estate community, real estate investment community. And we also want to share what we know. There's some unique lessons that we learned, and also there are like resources that we end up developing, because as much help as we could, we wish there's more. So we are creating new resources to help entrepreneurs build their, let's say when you're first starting out, you need to focus more on sales and operations, and then the next step would probably be like marketing side, and then HR and everything. So we have built an infrastructure for Real Estate IQ. We want to share either through sharing our company resources or our expertise, some coaching, consulting. We have a lot of brains in the organization now. We also want to work with more people, so we have more big brains that can offer, I guess, we want to help build a community where everybody help. And so Wade, Jeff, and Derek is our first time meeting. Nice to meet you.
Nice to meet you, Steve.
Thank you so much for putting this together for the community and offering your resources and your expertise. So we would love to actually talk more as well, see how we can collaborate more with a couple of these new launches that we're doing. So we have a membership. In short, there's a membership that helps you grow. We have a free membership. We have an elite level. We have a entrepreneur level, and then we also have an enterprise level. And as a member, you get lots of benefits, lots of discounts from folks that vendors in the community, and also in purchasing the Real Estate IQ leads as well. So I think it's kind of a no-brainer if you are big in the in real estate and real estate investments. And then when it comes to deal finding and deal locating, we have a lot of technology and data expertise to help you. And everything, I think the way we're structuring the company now is the sky is the limit. And I know a lot of folks, especially in the beginning stage, they need a CRM. So we're in the middle of putting that together. And we also want to engage our members, folks that are in the community, to build that together. So big philosophy, cultural change, actually from the recent years. So thank you for giving me the stage to share a little bit of that. I think we should share with you guys more.
Happy to do it.
Meeting.
Awesome. Thanks, Steve. So Derek, are there any questions?
There were some questions, so I'll bring those to you now. So first of all, we have a live question based on the ideas that were talked about earlier. With the pound being on the lower end, would it be advisable to invest in Europe?
Well,
I'm going to defer to you, gentlemen. I couldn't tell you. I'm not sure.
Yeah, I think on this particular webinar, I personally try to stay in our area of expertise, and I'd say I think Texas real estate is a very good investment. I'm not absolutely sure about Europe. I think Europe has some challenges, in my opinion. But Steve, your opinion?
Oh, I also don't feel comfortable sharing too much just because I don't know. I'll be kind of speaking out of shooting my mouth off. I will share with you that we have some connection with the UK folks in the real estate side. So I might be able to find their emails. If you are interested, I can connect you with them.
That's good.
There you go.
A couple of other questions. Do you think it's a good time for investors to invest in a higher rate environment?
I think we covered that at length, but I'm gonna say yes. Like what you can. I think one of our loan officers said, I've never heard this before. Said, date the rate and marry the house. So yes. Like I was saying, real estate investing is a good business over time. Historically, you get some great returns, even with rates being higher now than they were a year ago. You know, think about it this way: there were plenty of people still investing in real estate when rates were at this level. Last time they were, people were still doing it, and if you ask them how they did between whenever it was, like it's 2008 and now, they're probably pretty happy if they bought a rental property and kept it because they could have refinanced it. They certainly, I can't imagine a scenario where they bought a house back in 08 or 09 and it's worth less now than it was back then. So
That's
so
impossible.
even though it's not as, what's that?
That's impossible. I
Yeah,
guess there's no way.
Like, unless it burned to the ground, it's got to be worth more money, right? So I would say definitely yes. There's no time like now, and if rates, you know, when rates go back down, you can refinance, or like we just said, rents have been going up. They went up $200 just last year in San Antonio alone. So even if you're worried about cash flow with a higher interest rate, you're eventually your rents are going to catch up.
I think everything is perspective. You know, we think it's high right now because the past couple of years we had like super low interest, excuse me, 2-3% interest rate, and by comparison, we think we're quite high now. But you know, back in the 80s, like we were looking at 18% interest rate. So I think it's about perspective, and as real estate investors, if we have the long-term mindset, and really if the cash flow can cover what it is now, who cares how much the rate is and how much the house is in general. And again, we can refinance when the rate comes down.
I'd mention one other thing on that topic, Derek. It's not only a choice to invest in real estate or not invest in real estate. The choice is, what are the other alternatives, right? So you leave money in cash, you're losing 8.5% purchasing power. That doesn't sound like a great option. Stock market is unstable at best, you know, down 20-something% in the relatively recent past. So you really have to evaluate what your alternatives are. And even if home prices do go down slightly, you know, your investors don't buy at retail price, right? They get equity capture up front. Oftentimes, you know, 20, 25, maybe 15% equity capture up front, depending on the marketplace you're in. You get immediate cash flow, you get tax advantages. There's so many different positive things associated with it that whenever you look at all those things combined, even at higher interest rates, I think it's still darn attractive.
Anything else, Derek?
We have one more question as we approach the top of the hour. Good timing. Thank everyone for staying with us. The final question is, where do we see rates going over the next few years?
Ooh.
That's a tough one. I mean, I think the Fed has made some announcements on that, right? They definitely have announced that they have a higher target rate than they had said just a few months ago. So I think rates are going to continue to increase definitely through the end of this year, probably a large part of next year. Maybe it stabilizes. I think it does depend on what the economic data says. You know, the two factors are recession or the overall economy, and then the inflation numbers. Right now, it seems like the Fed's more concerned about inflation than anything else, but that could switch over time. And that swing, the pendulum swinging there, is going to dictate their policy. I do believe very strongly that in the next 2 to 3 years, rates are going to come down. I think it's very hard to increase interest rates this much, this fast, and to not have a big impact on the economy. The Fed said that that's their goal, right? They know that there's going to be pain. That's the only way they can stop inflation. So when that pain hits, we have to kind of counteract that eventually. So I think if you can get into a property now, like we talked about earlier, at where your cash flowing well, even with higher rates, you're definitely going to have great refi opportunities in the next, I'm assuming, 2 to 3 years. That's my guess.
That's around the horizon. And again, I wouldn't say I'm the authority on this. So, but my gut feel is similar to Wade, and he has more insider information. So I'll go with Wade.
Thanks, Steve. We both have our areas of expertise. You have many, sir. So yeah, we appreciate all your insight today. It's been great. You always bring a lot of great insight, both on the data that we're covering, and then your insights just talking to investors and helping them succeed. So we definitely appreciate you today as always. And Derek, Jeff, great job. And I think at this point, we can tell everybody best wishes unless there are any other announcements, Derek.
That's exactly why we do what we do. I mean, we want to bring this knowledge to those that are watching this monthly market update. We definitely want everybody to tune in next month to our October market update. And we're so excited to have had Steve today with Real Estate IQ, and Wade and Jeff. Thank you so much for the knowledge as you bring it. And if anybody does have any further questions, feel free to look at the information on the screen. Reach out to us, and if it's a specific question to your investing needs at Catalyst Funding, we can put you together with a loan officer to answer your specific questions. So let us know if you need us to connect you with one of those people. With that being said, thanks for attending today's webinar. Anything else, gentlemen?
That's it. Appreciate you guys. Thanks, Steve.
Talk to you all soon.
Have a great day. Thanks, Steve.
Thanks, everyone.
Bye-bye.